Yeah, I mean, they've been quite resilient despite all the uncertainties that the market faces, that corporations face right now. We're looking for 2022 earnings growth of 7.5%. That's right in line with the long-term average of about 8% per quarter. So it's not really a dire situation, and it comes on the back of what was one of the most strong years from an earnings growth perspective out of very many in 2021. So the comps are a little more difficult. We're still going to get solid growth, and I think where we've been seeing shifting in numbers is really within different sectors. So of course you're seeing sectors like energy and materials. Those numbers are moving higher along with commodity prices, but then you see consumer discretionary and communication services moving lower along with consumer sentiment. So I think there's some moving parts here. Time will tell. It's going to be a really interesting earnings season because corporate America really has been able to weather a lot of the uncertainty that started in the fourth quarter of last year, including inflation and uncertainty about the Fed and the direction and the path forward there. They weathered that really well in the fourth quarter as the market started turning down, and I expect they're actually going to be able to do the same this quarter.
Which sector has the most downside risk? You said energy, obviously the biggest upside. Which one biggest downside risk given everything that's happening right now?
Yeah, the biggest downside risk, I think, is, most people would probably initially gravitate to the consumer discretionary sector, but it's one of three sectors that is expected to show a decline. It's expected to show a decline of 10% in the first quarter. And I actually think that might be a sector where there's opportunity. What we've actually seen is the majority of that pullback in growth is coming from the consumer services sector. And so the consumer, I think, in general remains very, very healthy, just like Mike and your last guest talked about. They have excess savings to the tune of $2 trillion. They have much lower debt levels than they did coming into the pandemic here. They've really right-sized their balance sheets, and they've shown the ability to absorb higher prices thus far. The job market remains very, very attractive to them and anyone that's looking for a job. So I think the consumer remains very strong. We've seen consumer services, while some of those companies have done really well, like restaurants and hotels, those numbers remain very depressed from an earnings perspective. And I think that's where you might be able to see actually some upside surprise. I also would look at the tech sector too. Well, numbers have been pretty steady there so far. Just like last quarter, the expectations coming in are very low. I think this is a sector that a lot of people aren't expecting too much from, even despite the move back in the stock prices here. So I think that might be an area where you see better growth, because growth there has been really good over the last several quarters, but it hasn't really outperformed the S&P 500 in the last couple of quarters. And I think that there's a bigger opportunity coming down the road. Yeah.